Okay, chapter 2, consolidations. This chapter covers the accounting that occurs immediately following the acquisition of a wholly or partially owned subsidiary. Uh, so, why do firms go out and buy others? Vertical integration to be able to control your supply chain, entry into markets, economies of scale. We can certainly cut the administrative cost by acquiring additional firms and managing them centrally out of a headquarters someplace. This one's a little dated, 2017. Some recent acquisitions. There are certainly some more recent ones that are listed in the Wall Street Journal and such. So, once a firm acquires another firm in a wholly owned manner, certainly there are a number of options to be considered. The One, are we going to continue to operate the subsidiary in as an independent legal entity, um, or are we going to combine them into the main company and dissolve the target, the subsidiary? In the first case, we will consolidate the financial statements. So one statement is more meaningful. It fairly presents all of the activities of the group rather than the individual entities. So, what are the options for business combinations? Business combinations come in a variety of legal forms. It can be as simple as going out and acquiring all of the common stock of a business, a capital purchase, or it can be an asset purchase where you just obtain all of the assets and often the liabilities of another company, and in order to acquire it. And then once you acquire control, as I mentioned earlier, you have either one, you dissolve the acquired company, or you don't dissolve it. So if you dissolve it, that's a statutory consolidation, and creates a new company, and all of the assets are transferred, liabilities are transferred into this new entity. Or more commonly, companies frequently leave the targeted company for statutory reasons, might be an international acquisition that requires the company to continue. All right, so this is a quick summary. So the first three are the company dissolves. So let's talk briefly about an asset merger. Why would you go about and do an asset acquisition rather than a capital acquisition? And one of the most common reasons is the possibility of unrecorded liabilities. So if you've got a company who has involved in an industry where there's often some environmental issues, then you may not want to buy the company through the capital acquisition, because if you do and the EPA comes in 5, even 10 years down the road and determines that former subsidiary that you acquired polluted the local groundwater, for instance, then you will be liable for that. Whereas if you'd gone through and done an asset acquisition, then that unrecorded liability disappears with the dissolution of the target company. So the control model that we work from, is noted in Chapter 1, is anything above 50%. So any acquisition of more than half of the target company requires consolidation. So once they gain consolidation, so how are we going to prepare a single set of financial statements? Well, we do so in the case of a non-dissolution, because in the case of a dissolution, um, we go through and just make one big journal entry into the parent's books. So all account balances are just physically consolidated into the parent's general ledger, and then the accounting department and everything else of the target subsidiary disappears. If separate, then we use work papers. We use a consolidation worksheet, which is the basis of your midterm. And we'll talk about that extensively here shortly. If dissolution occurs, accounting records are gone, you dissolve all of that, you no longer keep them up to date. But if the separate incorporation is maintained, then you continue to utilize the general ledger of the targeted company, the subsidiary. They continue to write their own checks, they do their own payroll, they collect their own receivables, and the like. Okay? So the acquisition method is either one, you step up, you're going to record the investment at the purchase price. You will, in the consolidation process, step up any liability assets and liabilities that have differing fair market values than book values in the subsidiary, and you will record, if at the end of that, the excess of the purchase price over book value, and after subtracting the specifically identified assets and liabilities, then you book goodwill. If, however, after subtracting the specifically identified assets and liabilities, the goodwill is driven into a negative figure, then that is a gain on bargain purchase, and that gain is recognized in the current income statement. Okay? So fair value, what is fair value? Three valuation techniques. The market approach, and that is that the subsidiary is actively traded on a open market, or an income approach where you discount back the future cash flows, and then lastly a cost, what is the replacement value of the assets and liabilities. As I mentioned, if the consideration transfer does not equal the fair value of all the assets acquired, then you have a gain on bargain purchase. So if the fair value of the assets acquired assumes the consideration, the purchase price, then you have a gain. Otherwise, you have goodwill. So quick example, BigNet pays cash of $550,000 and issues 20,000 shares of stock that is currently selling for $100 per share. So the value of the stock is $1 million. Add in the 550,000, $1,550,000 is the purchase price. Let's see here. Yep. Okay, so $2 million, not $1 million. $2,550,000 is the consideration, and then dissolution takes place. So the fair value of all the current assets and liabilities equals the $2,550,000. So there is no goodwill to be recorded. So you record all of it as one big journal entry, debit the current assets, all the other property, plant, and equipment, both tangible and intangible, the liabilities, debit out the cash paid, this common stock, and the additional paid in capital. All right. Let's say we now pay $1 million in addition to the $2 million worth of material. The consideration paid is going to be in excess of $450,000 in goodwill. So now we have goodwill being booked at the $450 both of these examples are the company is dissolved after the acquisition. Okay. So bargain purchase, let's say we only give them the $2 million worth of stock. We don't give them the $550,000 in cash on top of that. Well, we're still going to record this current assets, the computer and equipment, the capitalized software, the customer contracts, and then the liability. Now we have, in essence, what is known as negative goodwill, and we record that as a gain on bargain purchase and take that $550,000 gain to the income statement in the current period. All related costs, attorneys, appraisers, accountants, management time, secretarial time, all of these are expensed as incurred. If we have to register and issue new securities in association with this acquisition, then we reduce the fair value of the securities by that amount. So here's $100,000 worth of professional services. We have salaries and administrative expenses for the internal cost. And then we reduce the additional paid-in capital by $20,000 that we issued for the stock. Okay. So if it's not dissolved, then we need to prepare a worksheet. So we go back to acquiring now issuing $26,000 at $100, so $2.6 million. We pay $40,000 to a third party for its assistance in issuing the stock. In addition, we are going to pay an additional $83,200 if the earnings exceed $300,000 for the next annual period. That has a present value of $20,000 as a contingent liability. And I'll have examples of that when I do the problems here shortly. So we have a total of $2.6 million in stock that is transferred, and $20,000 worth of fair value, contingent liability. So this is a total here of, we do a debit to the investment, we record the contingent liability, the issuance of stock at par, and the additional paid-in capital. And then we expense the $40,000 that we paid to outside services. Then we come to the consolidated worksheet. And what this is, at the date of the acquisition, we have 2 of our 5 adjustments. So we have an S adjustment, which is to remove the capital stockholders' equity. So that's the common stock, the additional paid-in capital, and the retained earnings of the subsidiary. We're going to debit the investment in Smallport. Then we're going to increase the fair value on the A entry of the computer and equipment, the capitalized software, the customer contract, and book the $70,000 in goodwill, and that's the A entry, as well as increase the liability by $50,000, and that's the A entry. So we have the S and the A entry, and I will do problems associated with that. I'll do at least 2 or 3 problems in the next video. All right, thank you.